Hey everybody, I'm Bill Faeth, and this is my good friend Ryan Bakke. Welcome to Tax Tuesdays, everybody. Always the most exciting day of the week, Ryan, is to be Tuesday and talk about taxes, right?
Yeah, I would say so.
I mean,
If
we should be talking about football today.
Yeah, the Buccaneers did not perform last night. I don't know how you had the game, but I thought they had a chance. But looking into it, when you look at their win-loss record, they never really beat anybody that was good. So
Who did they play?
last night,
Yeah,
they got whooped by Dallas.
that's unfortunate. I'm not a big Dallas fan. I had no idea about football at all this weekend. So you got is a housekeeper there, or your fiance?
Yeah, in the
Nice.
background there.
The only thing that I know about what went on over the weekend was the comeback by the Jaguars over the Chargers, which sounded pretty insane.
27-0.
That's like a Brady comeback against the Falcons in the Super Bowl.
Yeah, I would not be surprised to see the Chargers coach get fired.
Right. Awesome. Well, we're not going to talk about football all day, everybody. I'm Bill Faeth. You can follow me on Instagram, bfaith73. Ryan is Learn Like a CPA. There's probably not more content being put out than what you and I put out on our Instagram reels every day. I'm getting ready to ramp mine up to go to multiple times per day across all of my social channels. Just want to continue to drive value. I'm really appreciative for Ryan to join me. Pretty much every Tuesday. I will not be here next week. Just FYI, I will be snowmobiling in Yellowstone National Park. Super stoked and excited to that. Ryan, are you going to do Tax Tuesday next week?
Yeah, I could either host it myself or we could find a sub.
Okay. Well, you know what? I'll leave that up to you and Chris. So Tax Tuesday will be happening next week. Ryan will have a special guest for you next week. So if you've never been to Tax Tuesdays before, please leave a comment right down below. And Ryan and I'm here just for the color commentary, but Ryan's here to answer all your tax questions. Ryan, I'm going to start us off today because I had a conversation with my new COSEG guy a few hours ago, and he was quizzing me about when I put my property into service and when I started my renovation. And he was telling me that if I put my property into service before I start renovation, and that kind of commercializes the property, then I can get a larger percentage of bonus, right? Can you talk about that a little bit? Because I know there's a lot of people that think different things of what they can and they cannot do to really maximize their cost depreciation. But I don't hear a whole lot of people outside of yourself. And then the conversation with this gentleman in regards to how I can really maximize that percentage I would get a return on.
Yeah, so it all goes down to the accounting term of when you actually place the property into service. So historically, for long-term rentals and multifamily, that was as simple as making sure that it's permitted and occupied and up to code, and then sticking a for rent sign or a flyer out saying that it's going to be rentable. But for short-term rentals, it's a little different. We think that it has to be permitted, licensed with the city, and then listed on Airbnb. But the strategy there is some of the expenses that you have for an Airbnb, some of them are rehab and renovation in nature, and then some of them are more cosmetic and kind of like facelift. And so the idea is try to get your property rented and in service with the renovation piece, and then come in and do the facelift and the cosmetic something later, maybe during slow season.
That is awesome. Welcome. Hey, we got a first-time listener, Nick Vandersloos. Welcome, Nick. Thanks for joining us. If you guys are just joining in, we're talking right now about cost segregations, and Ryan's educating us on a strategy of how we can maximize more than our typical return percentage-wise on a cost seg. So does that mean, what is it? So I get the long-term part. Do I need to list on Airbnb and Vrbo, or could I take like a couple of direct bookings to have that qualify? I mean, if we went through an audit, what do I really need to do to make that work?
Yeah, so I talk about that in the podcast that I released on this topic, but to me, it has to be listed so that anybody in the world or anybody in that area can rent it at a fair market rent. So to put it on a direct booking website, and let's say your average nightly rate is $500, and you were to list it for say $2,000, thinking that nobody would ever book it, but hey, it's still considered placed in the service. in my opinion, that wouldn't fly because it's not able to be rented at a fair market rate.
Gotcha. That makes total sense. So you really can't fudge it, basically, is what you're saying. If you do, you could get bit when you get audited.
Right. You're not able to fudge it, but I mean, I'll give you some real life numbers. So when I completed a rehab, it was a total of about $30,000 of total cost between, and this was on a multifamily, it's different than a short-term rental, but there was about $16,000 to $17,000 of expenses that were rehab, renovation, plumbing, HVAC work, where there was no way I was getting around doing that to get the property up to code. But the other $13,000 to $14,000 of expenses, I was able to come in after I had, stick that for rent sign out in front, right? And then come in and do the rest of those items where now I'm able to expense those $14,000 of costs as opposed to having to add those to the basis of the property and then depreciate it over time. So just knowing that alone had saved me, let's say 14,000 times my tax rate, 30% or so, just knowing that alone saved me $3,400 in taxes.
Right. So it's really interesting that you bring that up. So the part of the conversation, I have 4 cost seg properties still on my 2022 tax return. 2 properties were purchased in 21. 2 properties were purchased in 22. The 2 properties that were purchased in 21, one of them, a beach property, I immediately started renovation on December 9th or whatever. We didn't put it into service until March. Got $100,000 reno done, floors, appliances, blah, blah, blah. But then I had to order windows because it's a beachfront. I needed new hurricane windows, right? That's about a $20,000 expense. Those didn't come in till September. And a lot of people are thinking, how do I work that into my cost seg, right? But really, they probably don't want to. They really probably want to take that as an expense right off the top of their income, right?
That's right.
That's what you're saying.
Yeah, I mean, and I just got off the phone with somebody today on a call, and that I'm actually filming a podcast on this tomorrow, but that all goes towards your strategy of beginning stages of an investor versus now you're a more seasoned investor, because how you present your tax returns and what you show as deductions means all of the world when it comes to loanability and banking. So one of the common mistakes that I see, especially real estate agents or new realtors, is they'll make $120,000, $150,000, then they'll go buy a $50,000, $60,000 car. Well, they're like, oh, I made 150 grand, I should qualify for houses, etc. But then the bank says, well, wait a minute, you use this vehicle in your business, we're not able to add this back to your profit and loss, and so we're only going to qualify you for $70,000 of income as opposed to 150. So you have to be very careful, especially people who are leaving a W-2 or corporate America and then going self-employed, whether it's through co-hosting, arbitrage, Airbnb full time. Is be careful with the expenses that you take on the front end. Because a lot of people will hear people, oh, you want to deduct or expense or write off everything. But for loanability and banking purposes, you want to make sure that you're writing off the right items, stuff that they'll actually add back. And as we know, depreciation through rental properties is one of those things that they'll add back.
So I know you can answer this, but this is a question I would typically pose to John Hodge, the Super Team Accelerator Bank Whisperer, right? But are banks looking at the total gross income, or are they looking at the adjusted gross income? So total gross could be your $100,000 W-2 and $100,000 in rental income, so you have $200,000. But you got a $50,000 cost seg benefit, so now your adjusted gross comes down to $150,000. What are banks looking at? Which one? Because I think there's a lot of confusion.
Right. Yeah. So if you look at Fannie and Freddie guidelines that are even listed online, it tells them specifically to take the net operating income, which is that bottom all expenses paid item, and add back depreciation. Right? So you're able to add back that 18 that you took off your income, that cost segregation, that accelerated depreciation. You're able to add that back to your income versus your realtor.
I'm sure you get a lot of questions about that, right? And
yeah,
a lot of people don't understand that. Can you say that one more time just so they get it?
Yeah. So let's say I'm a realtor and I make 150 grand and I buy $100,000 vehicle. Well, my income is going to be $50,000 because I wrote off the vehicle. They're not able to add the vehicle back. But if I had $150,000 of income and maybe I had $100,000 of depreciation from a rental property that I just bought, my income is still going to be that $150,000 because they're going to add back that $100,000 of depreciation to my income
after buying the car, right? So if you
Right.
don't buy that car, then you could potentially show 250 if you had $100,000 in rental income that
Sure.
offset depreciation. Awesome, that's really good stuff. For those of you that are just jumping in, please say hi below in the comments. Let Ryan and I know where you are from, and pop in your questions. If you've never been to Tax Tuesdays before, Ryan is the resident STR Super Team tax advisor. He's gracious enough to join me pretty much every Tuesday, at least up until tax season, to make sure you guys are fully prepared with the documents that you need, taking advantage you need. And Ryan, I'm going to put you on the hot seat because last week you said you were going to tell them how do they save $10,000 between now and tax day, right? I want to know this myself because I'd like to save 10 G's.
How do you save $10,000 between now and tax day? Well, I will say that the easiest way to save $10,000 in real estate is to not have to send $10,000 to Uncle Sam, right? There's a variety of ways that you're able to do this, right? So we've talked before about opening up retirement accounts, a SEP IRA, solo 401k, but not everybody wants to invest into retirement accounts, right? A lot of us don't. Oh, there we go.
There we go. I'm giving you some music. How do we save 10 grand? We got a budget. You know it.
And so, I mean, another form is to just check where your profit and loss came in. So if I'm looking at my profit and loss from my rental properties, and let's say I have $50,000 of rental income that I'm showing for tax purposes. Well, if I have $50,000 of income and I'm in a 30% tax rate, I have to pay 15 grand to Uncle Sam. Something as, hey, should I accelerate depreciation on one of the properties that I bought this year? Well, now instead of having to pay 15 grand to Uncle Sam, that tax bill goes away. And I just save 15 grand that way. But I will say the right way to do tax planning is before the year is even over. And so you should be tax planning for your 2023 year right now as we're in 2023.
Agreed 100%. And that's one of the reasons you have like quarterly meetings, or you don't wait until 2023 to start discussing 2022 with your clients, correct? You're kind of planning through the entire year.
That's right. Yeah, we'll typically do, depending on when everybody signs up, but we'll typically do 3 to 4 meetings. Quarterly makes sense, but really there's this sort of like an action plan meeting where here's everything that we're going to do this year. Here's what you should do. Here's what you shouldn't do. And then there's, of course, check-ins and follow-ups. But then typically November or December, we'll do like a year-end meeting where we kind of put a bow on everything. And one of the things that I like to do is let clients know, what can they expect to owe or get back on April 15th, way before April 15th. And so, like I presented before in a webinar that I did last month is, speed is very important. Like you need to know if you're going to owe money or get back money. Having those draft tax returns is also important too. So I told you the commercial loan that I'm trying to apply for now, they want draft returns. They want returns for 2022. This was 2 weeks ago. This 2022 had just ended and they wanted draft returns already. So depending on what, level you're at when it comes to investing, whether you're just getting that 10% down secondary home loan or you're more advanced and starting to do commercial style loans, the banks are going to be more demanding of the information that you can give them. And typically it's going to be with your tax returns.
It's interesting because I'm going to go back to the bank whisperer, John Hodge again. When he did his accelerator module, he's teaching everybody about the level 1, level 2, and level 3 documentation that you need for to really be bankable. And it's different, like as Ryan's talking about for Fannie and Freddie, which I'm doing right now for the first time ever, versus going to your local credit union, regular bank, doing a commercial loan versus a DSCR product, right? And I think it's interesting that you bring up the draft of a tax return. Essentially, that kind of replaces an audited P&L, right? For a business, if you're putting, because I assume if you're having to submit a draft, you're signing it, right? When you're giving somebody a draft to give to a bank, and we're not in most banks, when you're doing a $500,000 deal, probably aren't going to ask for something like that. But you get up to $1 million plus today, and that's something for those of you that have not bought or tried to qualify for a property in the last 9 months. Banking has changed. It's really tightened up. I share this with our super team. I'm pretty overqualified usually for what I buy. And even right now, I'm glad I'm working with one of the best, second home guys in the country, because It's interesting. If they wouldn't have qualified me on a single year tax return because of how bad 2020 was, it would have been a challenge for this $1 million lifestyle asset that I'm buying now. Even though before this property, Ryan, my debt to income ratio was 8%. Even with adding, and that's based on this last year's tax return. But if I have to average 20 and 21, because 2020 was so bad for me, my income plummets. And I literally go from 8% to like 37%. Then I add this on and I wouldn't qualify traditionally. So there's a lot of things that we really need to understand on the tax side and the banking side. So we talk a lot about how, like, Ryan and Jeff Hampton, the SDR law guys and the CPA, the attorney and the CPA, they need to communicate hand in hand. And it's, once again, another use case. So I have a client that I just introduced Ryan and Jeff to together because he knows the value of having them together as opposed to not communicating individually. And I'm sure you see that in a lot of your consulting clients that gets bad information, maybe good information from a legal side, but it impacts your clients negatively on a tax side. What are some of those things that you see get lost in that translation?
Yeah, a lot of times it's one hand it's not one hand talking to the other for most people, but it's one hand telling you to go talk to the other hand. It's
Right.
saying, it's your lawyer saying, well, this is what we're going to do here, but you really need to go talk to your accountant or your tax advisor, or vice versa, right? That's why I'm not qualified to give legal advice. Now, have I been doing it enough to be dangerous? Absolutely. And I could say a little thing or two, but I'm not qualified to give that advice. I will say the biggest kind of concern that we get between my tax and legal advice is definitely entity structure. A lot of people have questions about entity structure. You know, should I have an LLC? Should I have a trust? Should I have a different LLC if I'm doing co-hosting, arbitrage, property management, or my own rentals? That question is not just an entity question. It's a tax question. You know, it's a loanability. It's a financing question. You know, if you set up an entity, and let's say I have an entity for my co-hosting business. Well, now if I want to qualify for loans in that business, it's going to be based on my business credit, not necessarily my personal income. And so that's what we talked about on the accelerator call last week. Is a lot of people come into situations with a question that they have that's pertinent to their situation that needs to be answered quickly, but they have blinders on. People will have blinders on and they don't know what they don't know. They think they come with an entity structure question, and I've seen this all the time, where they come with this sort of question, but I'll say, hey, did you think about this? What did you think about this? Or has this come across? And they're like, well, no, I never even thought of it that way. I didn't think that had an impact. So I wonder how many short-term rental investors, how many real estate investors out there that have those questions where it's such a one-dimensional question that they think, but really it's a Pandora's box for a bunch of other conversations.
That's really interesting. And I mean, honestly, I say this like every Tuesday, you could save me probably $600,000 to $1 million in the year and a half that we've known each other. And it's not, you don't, like you said, you don't know what you don't know, right? And I'm still learning and you're learning and we're all learning on this journey. I can't emphasize enough how important it is to have great tax planning strategy. It's one thing to have a W-2 and that's your single source of income, but when you're investing into real estate, there is so many opportunities. Ryan, what are a couple of those that, you know, it seems like every week it's cost segregation, material participation hours, what can I do, what can I not do? And then a lot of people are asking about investing advice. We talked about that after last week's Tax Tuesdays. What are some things that most people, at least, and let's just say that doesn't even matter if they have a W-2 or an entrepreneur, but they're kind of newbie to intermediate in the SDR space. What are they missing from either a depreciation write-off standpoint to mitigate their tax burden?
Yeah, I mean, just the basic one that we see all the time is people are missing, you know, even something as simple as Airbnb fees. So when Airbnb gives you your summary, they're telling you how much they are, you know, deducting for their service fee. It's 3% service fee. So I don't see people's profit and loss statements are not including something like that, where, hey, 3% service fee on an $100,000 grossing property. I mean, that's no joke. That's a couple $1,000. Some of the other common items that I see that I always point out too is travel back and forth between your primary and your rental. if we're taking airplanes or flying or we're driving, a lot of people are not logging their miles that they drive back and forth because you're able to deduct your travel expenses most of the time. Also, too, we run businesses off of this guy right here, and I see people miss their phone bill or miss their internet or their Wi-Fi bill. Those are all expenses to your business if you're using it for business reasons, your cell phone or your internet.
Hey, Sheila, how are you? Thanks for joining us. Look forward to seeing you in Orlando at our mastermind meeting in a couple weeks, Sheila. Okay, Ryan, let me unpack what you just said. I have a property under contract in Montana right now. I've flown there once since I've been under contract. My wife is flying there to close. Can I write off my airfare, my food, my rental car, that type of stuff prior to close?
Okay, good question. So here's the rule. Here's how it works. So every taxpayer has a place of business, or your business home can be different than what's called your tax home. So your tax home is usually where you live, where you reside. So I live in southwest suburbs of Chicago. You live just outside Nashville, right? Yeah. So that's our tax home. But we could also have businesses, rentals in other states. Now the rule is, if you do not close on a property, you technically don't have business purpose there. So if I go to, let's say I fly to Florida and I'm going to look at properties, but I don't put an offer on anything. Well, I don't have any business purpose in Florida yet, so I'm not able to deduct my expenses. Now, if I fly to Florida, put a property under contract and close on that property, well, now I have business activity in Florida and I am able to write off those travel, planes, meals, etc. So you have to have a business purpose. Now, let's say I had a property in Florida already and I flew down there to check out another property. Well, I am already doing business in the state of Florida at that location. So those costs are going to be deductible whether or not I close on that second deal or not, because I'm already doing business in Florida.
So my first trip for this property to Whitefish happened the week before Christmas. So that expense fell into 2022. My trip to go do the home inspection was in 2023, right? So I assume, since I won't close until 2023, but I will close before I file, can I write off that travel expense in 2022?
I would carry it. I would write it off in 2023 when you
carry the expense forward. Gotcha.
Yeah.
So next question. Go ahead.
That I was going to say, a thing too, what's funny is we own multiple businesses in the short-term rental space, right? So I have a CPA firm, I have a content, creation business, I have a guest speaking, if you will, business, and I also am putting together partnerships, right? Syndication style structure. I should be able to expense whatever I want if I'm going for real estate, right? It's just which business do I want to kind of classify that expense under? And I think that's what's, about being in this business full time, is we have different avenues and kind of different ways that we're able to, get involved in the short-term rental space. And for me, that's awesome, because as long as I'm talking real estate, I'm going there for real estate, I should be able to find a way to deduct something.
There's also some pretty serious strategy if some of those businesses fall into varying tax brackets that people don't understand. Not every one of those businesses might fall into the 30% tax bracket, right? So right. I think that and this is the thing about the in-depth conversations that happen with somebody like Ryan, and those are typically something you're not going to have with your regular CPA. That's why you should surround yourself with people that know more about this shit than you do. I didn't know until I went through probably a year and a half, probably 2.5 years ago, that I could have multiple business in different tax brackets. And it's very interesting to me. So now I kind of think about, I meet with my CPA quarterly. Ryan and I talk all the time. And I've got 7 current businesses. And my primary business for the last 7 years is now my lowest grossing business. I pretty much flattened it out to zero, to where I can almost use that as a tax haven be able to pay from other companies into that marketing agency. You know what I mean? And then I can write expenses off. So I think there's a lot of strategy that people don't understand if they have multiple entities. Now, you got to do legit business, when you're going there. But the types of businesses you have, the types of businesses that I have, it makes it fairly easy, to be able to justify those things. This is, and we don't have any questions coming in, so I'm just asking questions on our listeners' behalf. If I go to dinner when I'm visiting one of my properties, can I write that off? And I know the answer to that, but what becomes excessive? Is there excessive?
Yeah.
And is that determined by the freaking auditor, or could that tie into normal lifestyle? How does that work?
I think that's the key point there, is the normal lifestyle. Right?
So you would have a problem if you got audited writing off a $300 bottle of wine. I wouldn't.
I'm thinking that, yeah. What is ordinary necessary in your course of business? I also think it would be, who's the meeting with,
and potentially what the value of that would be.
Right. Is it with a low dollar, co-hosting client, or is it with a more sophisticated investor that you might be, hundreds of thousands of dollars, right?
Yeah, and
a lot of it's up.
I'm going to give you an example.
Interpretation.
I literally took my neighbor to dinner because he doesn't want STRs there, and I wanted to make friends with him ahead of time, and his wife loves wine. So I literally don't buy the property. If I asked them for their blessing, I said, I will not buy the property if you do not want me to buy the property, because I want to be a good steward and a great neighbor, and I legitimately would walk away. I'm interested to know. I don't ever want to have to get this answer because I don't want to go through an audit. But I bought a $200 bottle of wine. Pretty standard for me and my wife when we go to dinner. Pretty standard when we've been on business dinners, right? Together. So I'm just wondering, is that excessive, or would the audit, if I had the proof to say, look, I do this all the time, this is the way I roll, and I can't buy this $1 million property if I don't get this guy's blessing, if I'd be able to write that off or not?
That's a good question. I don't know the answer.
Because I think a lot of people take advantage of write-off dinners, right? And that's kind of where I'm leading up to. If you go to Applebee's for dinner, and then you go and you actually are doing a vacation, and you go from $20 a person at Applebee's to $100 a person, then you're probably going to have a problem, right? So then the next question I have, if I'm going on workcation to one of my properties, what's the minimum number of hours that I have to work and document in a day to not be classified as taking vacation and to qualify for material participation?
Yeah, good question. So if you look at the Schedule E of your tax return, it's where your rental properties are reported. They actually want you to report your fair rental days, which is how many days that you rented the property out, as well as what are called your personal use days. And the reason they do that is because you're not able to get any deductions that are attributable to your personal use, which makes sense, right? I shouldn't be able to write off, all these expenses if I'm there using the property for personal use. I should not be able to write those off as business expenses. And so if you run afoul of this, you run into some trouble of not being able to deduct some of those expenses. Now, if you're working at if you're at the property and working at least 4 hours a day, then that day is not a personal use day. That day is just a regular business day, and it doesn't count against you. Under 4 hours is still considered a personal use day.
So what, can I just go to my house for one of my properties for a week and just work on stuff? Or, do I need to correlate Home Depot receipts? Hey, I went and bought a box of nails because I'm fixing the fence line, or, I bought, $300 worth of lumber or whatever. Obviously receipts are going to make it stronger, but is that required or necessary?
Yeah, what I do for my time log, and you could actually get this on my website. We could drop it. I'll drop it in the show notes later. But what I'll do is I'll put the date I'm there, which property, what exactly it is that I'm doing. So, for example, I had to snake the drain the other day in plumbing, and so I had to drive to Home Depot to grab a tool to come back to be able to do it. It took me about 2 hours total. Right. So I'm going to say, hey, I drove to Home Depot, grabbed this tool, came back, did the job. Some people will, especially if you're doing like cosmetic, or let's say you're putting up a game room, maybe you take a before and after picture and you upload that receipt. And so that's what is a good time log. If you're trying to, deduct these expenses as well as log your hours, is the date, which property, how long did it take you, and then some sort of proof or validation of the completed job. Project.
Really important to unpack that for a second, especially when you're in Destin or Gulf Shores in the summer Gatlinburg, and you got to run to Home Depot, and it takes you 45 minutes to an hour to get there and back. You got 2 hours round trip. Ryan's tracking that time because he's going to buy the tool. He went to, it sounds like you had to go buy a snake to come back to snake the toilet or the drain or whatever it is, right? So you're adding all of that in. If it takes an hour to do the job, well, 2 hours of drive time and 5 hours worth of actual 5 minutes of snaking, right? That's 2 hours and 5 minutes of material participation. Is that correct?
Right.
That is super important, folks. Super important, because a lot of you are taking vacations that if you got audited, you're going well over 14 days. You might be spending 2 weeks, 3 weeks, 4 weeks, 5 weeks there. You need to be on your workcation. You can check my Instagram and Ryan's, for reels on this exact thing. There's things that you really need to be doing. Once again, that's going to help you qualify for your tax benefit through material participation. So right now, it's the beginning of the year. Is there any recommendation for somebody that's has to qualify for whether it's 100 hours for one property or 500 hours, kind of the slow time of year that you recommend to try to accrue hours, especially if they've got properties rehabbed and they're not going to be spending a ton of time there? Anything that really they can be working on at home outside of, I'm sure that they can't put that they're spending 10 hours a week optimizing their listings, right?
Yeah, so I always try to strive for the 500-hour rule. That's like the gold standard that I call it. That's typically probably going to be at least 2 properties, if not 3. And sometimes it could depend on how it's substantial your rehab or renovation budget is too. Obviously the more rehab or the more work that you're doing, the more hours you'll generate. But typically try to aim for that 500-hour test across all your properties. And then if not, then you kind of move down to that 100-hour and more than any other person test. So typically that 100-hour test, you'll see a lot of people use if they buy property in, I would say August, September, October, November. We had a question that came in.
Yep, it's from Sheila. She's in Panama City Beach working on her properties. About 16 hours of repair supply hours a day, so no problem most days. I understand those 16-hour days, Sheila. And I've seen the stuff that she's doing that they're posting online. They're actually doing reno and stuff like that. But today I'm doing things in the condo that I normally do at home, paying Florida taxes, talking to customers, etc. So she's hosting essentially, right? All the things that go along without doing reno and handyman work and stuff like that she could do at home. Can she count those hours? I mean, I'm going to jump in and
I would say, yeah.
It doesn't matter where you're at, right?
Yeah, I would say those hours count.
I mean, I can tell you, I know I'm tracking when my wife submits our taxes and does that stuff. I mean, when you have a portfolio of our size, it probably takes my wife 5 to 7 hours a month to factor, remit, especially for those, places like VRBO doesn't pay the taxes. I keep telling her to switch to Avalara, so they'll do it for us. But, that's a lot of time. What are some things that happen? And I know we're over time here, but I want to ask you one more question. That's a great question, Sheila. What are some things that people do on a normal basis with hosting that they miss, that they should be counting in material participation that they don't? Because like one thing they can't do, Ryan, is like when they come to one of my conference or a boot camp or whatever, the education does not count, correct?
That's right. Yeah.
Is there anything that people do that they miss when you look at it?
Yeah, I think a lot of the times people will analyze comparable properties to see if their property's performing. That times count. So, for example, like if I'm looking at new properties to invest, that time is not going to count. But if I'm looking at properties in my area for the purposes of boosting the revenue of my property, then that time does count. Does that make sense?
Yep, absolutely. It does. Awesome. And you said that you have a pretty diligent process of tracking yours. Are you still using Reps Tracker, the app, to track all your stuff, or are you using a spreadsheet? Because what I've found is once you get to the volume that I have and you're catching up quickly, Reps Tracker is pretty easy with one property, but when you get a ton, it becomes a little bit more challenging.
Yeah, I actually have my own template that I made now. So for people who don't want to, download the Reps Tracker and pay the money per month, I just have a free downloadable Excel. It's on my website, learnlikeacpa.com /free tools, and you'll actually able to download it on the far right, it'll show which hours count, which ones don't, and then it'll also give you instructional guidance on how to complete your time log.
Nice. One more question, and then we'll go from Shannon. The education time doesn't count, like when you attend an event or do something online, but does the expense of the trip deductible?
Yes, that's
Really?
That's one of those where you don't get material participation time, but you're able to still deduct the expense because you're in the business of making your property, your business better. So now this is another thing. The education expenses are similar to the travel before and after expenses. So if I'm a newbie and I don't have any properties yet and I'm just getting started, well, the education expense is not going to be deductible for me because I don't have a business yet. But I get a rental property or I start co-hosting and I have a business. Well, then now that education expense is deductible. So similar rules.
Awesome stuff as always, Mr. Bakke. Thank you guys for joining us this week on Tax Tuesday. Not Wednesday, not Thursday, but Tuesday. Ryan will be back here next Tuesday with a special guest. I will not be here, so it'll probably be a better show, right? Ryan will be dominating. Maybe Kenny or Jeff or John or somebody.
We'll see. I already had Kenny, so
Kenny's out. No more Kenny. Awesome. Well, Ryan, have a great week. Have a great Tax Tuesday. I'll see you when I get back. Thanks for joining us, everybody. Happy hosting.